Introduction to Behavioral Finance in Personal Investment. Behavioral finance explores how psychological factors impact financial decision-making. It suggests that emotions, biases, and social influences can lead individuals to make irrational investment choices, affecting personal financial outcomes. Understanding these influences can help investors make more informed decisions. Influence of loss aversion on investment decisions. Loss aversion, a core concept in behavioral finance, describes the tendency to fear losses more than valuing gains. This bias can cause investors to hold on to losing investments longer than advisable or avoid risks altogether, limiting their potential for returns. Overconfidence and its effect on investment choices. Overconfidence bias can lead individuals to overestimate their knowledge or ability to predict market movements. This can result in risky investment behavior, such as overtrading or concentrating investments in one area, rather than diversifying for greater security. Herd mentality and following the crowd. Herd mentality is when individuals mimic the actions of a larger group, believing others are making the right choices. In the context of investing, this behavior can drive market bubbles, as investors flock to certain stocks or sectors without evaluating the underlying fundamentals. The role of anchoring in investment decisions. Anchoring occurs when investors fixate on a specific piece of information, such as the purchase price of a stock, and let it influence their future decisions. This can prevent them from adjusting their strategy based on current market conditions, leading to suboptimal investment choices. The impact of mental accounting on financial planning. Mental accounting refers to the way people categorize their money into different buckets, such as savings or spending money. This can lead to irrational financial decisions, like treating an investment win as extra money and spending it impulsively rather than reinvesting it for growth. Emotional decision-making and investment volatility. Emotions such as fear and greed often drive investment decisions, particularly during market volatility. Investors may panic and sell investments in a downturn or make impulsive, high-risk decisions during periods of market highs. Recognizing these emotions helps mitigate their negative impact. The importance of framing in investment choices. Framing is how information is presented and can influence investment decisions. For example, an investment might seem more attractive if it's framed as a 70% chance of success, rather than a 30% chance of failure, even if both statements are mathematically equivalent. This psychological effect can influence portfolio decisions. Losses and regret aversion in portfolio management. Regret aversion occurs when investors avoid making decisions that might lead to perceived regret, often causing them to hold on to poor investments or avoid new opportunities. This can prevent growth, as investors are reluctant to make necessary changes in their portfolios. Overcoming biases for better investment outcomes. Awareness of biases is the first step toward improving investment habits. By recognizing biases such as loss aversion, overconfidence, and herd mentality, investors can work to counteract them. Creating a clear, disciplined investment strategy and consulting with financial advisors can help avoid emotional pitfalls and improve long-term financial success.